So, good morning, Charles.
Morning, James. Thank you very much for having me on your show.
Well, thanks for coming back again. I think because we talked to you, I think last time just ahead of the merger, maybe. So it's good to have a sort of chance to catch up. So I think the best thing first, then, if I let you sort of run through the fund and what it's trying to do first, please, and then we can pick up with some questions.
Yeah, that's great. I'm afraid Murray Income is considerably less exciting than many of the trusts that you've just talked about.
That's a good thing.
But it might be quite topical given some of the comments there about Troy Income and Growth. So hopefully this might be particularly useful for any Troy Income and Growth shareholders. So just starting off with Murray Income's objective and key facts. So what we're trying to do really is three things: to generate a high income, to grow that income, and to deliver capital growth. And that's through an investment in a portfolio principally of UK equities. So we can invest up to 20% in overseas listed equities as well. So at the moment, gross assets are just under £1.1 billion. We have 51 holdings. Those overseas listed holdings make up about 19% of the portfolio. If you look at the size split, it's about a quarter in mid caps, 3/4 in large caps, and a high active share. Gearing's about 9%. The dividend yield 4.5%. And actually, 2023 is a big year for Murray Income because not only is it the trust's 100-year anniversary, but it's also the 50th consecutive year of dividend growth as well. Discount about 8%, competitive OCR of 50 basis points. And then sort of finally on this page, we're AA rated by MSCI for our ESG characteristics. And that's right at the top of the UK equity income peer group. So moving on to the next slide, and just to sort of briefly cover off performance. So on a sort of long-term 5 and 10-year view and longer, strong risk-adjusted returns, certainly top quartile versus the open-ended peer group. Over the last 3 years or so, value has performed well. So that's been a bit of a headwind given our focus on good quality companies. And over the last year, just a little bit ahead of the benchmark. But as you'll see in the rest of the presentation, I'm very confident about the portfolio's ability to deliver long-term outperformance. And this, you can see, is our 50 consecutive years of dividend growth. Probably worth saying as well, given the focus on good quality companies, the underlying income generation, particularly during the pandemic period, has been sort of considerably more robust than the market as a whole. We have some attractive revenue reserves, just over half of the full year dividend. And actually, if you go back over the last 50 years and add up all the dividends paid, it comes to about 850 pence. And in that period, we've used the revenue reserve a handful of times, and that's about 10 pence has been paid out of the revenue reserve compared to 850 pence in total. And I guess I just sort of like ask the listeners to think of maybe one question, which was in terms of the next 50 years of dividend growth and the sort of companies that you'd want to invest in order to help deliver that. What would those sorts of companies be? And hopefully I can sort of try and answer that question a little bit later. So this slide is the Murray Income investment proposition, really in a nutshell. So it's the 3 Ds. So we want to be dependable, we want to be diversified, and we want to be differentiated. So the part about being dependable is focusing on high quality companies with resilient income and good capital growth prospects, benefiting from a large team, writing proprietary research, with coming up with some great ideas, benefiting from corporate access of both executives and non-executives. And then the final part of dependable is really a sort of patient, low turnover, buy and hold approach, allowing the fundamentals to win through over time. So that's the dependable part. The diversified bit is not having all of your eggs in one basket. So thoughtful diversification by sector, by income, and by capital. As I've mentioned, diversification in terms of having the ability to invest up to 20% of assets in overseas companies, this healthy exposure to mid-cap companies. And we also have a modest option writing program. And that helps to, well, two reasons really. It helps to provide a little bit of headroom to invest in companies with perhaps lower starting yields, but better capital and dividend growth prospects. But also it helps to diversify the income stream a little bit as well. And typically that will generate around about 5% of the total income for the company in a year. And then the final D is being differentiated. So we think we're differentiated in terms of the focus on good quality companies, the diversification, the overseas listed holdings, the mid-cap exposure, that little bit of option writing, and also this sort of very strong ESG focus. So there's no tobacco. There are no tobacco holdings in the portfolio. And when you sort of amalgamate all of those factors together, you end up with a fund with an attractive dividend yield. It balances capital resilience in more challenging markets with the ability to capture good structural growth over the long term, and has delivered some strong returns, appealing on a risk-adjusted basis as well over the long term. So moving on to the next slide, and just talk a little bit about quality. So Murray Income works on the very simple thesis that if a company wants to grow its dividends over the long term, it needs to grow its earnings, and we think good quality companies are the best place to do that. So quality investing works because the market tends to underestimate the sustainability of returns from good quality companies. Good quality companies, they tend to have fewer tail risks, a greater margin of safety. They produce less volatile earning streams. And I think that's important from a dividend perspective as well, because good quality companies are more likely to actually deliver on their dividend aspirations. And then along the way, you might get special dividends as well. And typically, good quality companies can benefit from more challenging periods and capitalize on the opportunities that creates. And when we're thinking about quality, we're really looking at sort of 5 key factors, which in many ways are proxies for risk. So the sustainability and durability of a company's business model, the attractiveness of the industry in which it operates, the strength of the financials in terms of the balance sheet and cash flow of that company, the capability of management, how they're incentivized, their track record, and then last but not least, an assessment of the ESG risks and opportunities that company faces as well. So the next slide really demonstrates what happens when you sort of marry together quality on the one hand and income on the other. So quality provides this earnings resilience, strong business models, robust balance sheets, strong competitive advantages. Typically companies with high returns on invested capital. So that means they need less capital for growth, so they can hand back more to shareholders, or they can grow more strongly than average. And also companies with strong ESG characteristics. So that's quality. And then on the other side, you have income. So the dividend yield acts as a valuation backstop. Income is a very important part of total return. It's a touchstone for the health of the company. And it helps to reduce sort of agency risk as management teams need to think about investing for the long term in order to continue to pay the dividend. And so the sort of outcome, if you like, of putting quality and income together is this strong long-term capital growth potential, but also attractive and resilient earnings and income. So what Murray Income tries to do is like focus on the outcome in the middle of that Venn diagram. Just to talk a little bit more about diversification. So as I said before, thoughtful, sensible diversification by capital and income. And you can see on this slide how the capital is diversified by sector on the left, and then by the top 10 holdings on the right-hand side. And as a rule of thumb, I'm not keen to have more than 5% of the capital in any one particular holding. You can see RELX is a little bit above that at the moment. It's performed quite well, and actually there are some calls written on RELX. So when I expect them to be assigned, when they do, that RELX weight will fall a little bit towards that 5% level. And then on the next slide, you can see a similar picture, but in terms of the income. So not wanting to be heavily exposed to any one sector for the income, and also, again, as a rule of thumb, not really wanting to have more than 5% of the income coming from any one particular company. The next slide just highlights the differentiated proposition, hopefully on one slide. So you can see in the middle of the slide the quality companies, and not a coincidence, because focusing on quality companies is right at the heart of what we're trying to do. But also you can see the other points of differentiation. So the large and mid-cap exposures, that little bit of option writing, the overseas listed holdings, strong ESG focus, no tobacco in the portfolio, the diversification, this conservative patient buy and hold approach. So turnover typically is about 15% a year. The good long-term performance track record, and given the focus on good quality companies and a beta below 1, the portfolio tends to outperform in market drawdowns. So moving on to the next slide, just again to talk a little bit more about differentiation and the overseas listed companies, and really sort of 3 reasons for investing overseas. So firstly, to diversify risk in concentrated sectors in the UK. Secondly, to invest in better quality versions of UK listed companies. But thirdly, and most importantly, to provide access to industries that you just can't find in the UK. So some examples on this slide would be VAT Group, which is a Swiss vacuum valve manufacturer, which is dialed into the semiconductor capex cycle, Kone Elevators, LVMH Luxury Goods, L'Oreal Cosmetics. Acton is a Taiwanese company which benefits from data growth and artificial intelligence. Microsoft, obviously, the technology company, and Novo Nordisk, diabetes, and more recently weight loss. And then turning over to the next page, and I think hopefully this helps to sort of answer my sort of earlier sort of hypothetical question about if you wanted to grow the dividend for the next 50 years, what are the sorts of companies that you'd want to be invested in? And so these are the companies in the portfolio that have exposure to these unstoppable long-term trends. So that might be aging populations, or digital transformation, or the energy transition, or emerging global wealth. And hopefully these companies can ride the tailwinds of these enduring structural long-term trends, grow their earnings, grow their dividends, and hopefully provide that dividend growth for Murray Income and its shareholders as well. On the next page, you'll see just a quick sort of recap of why one would want to invest in UK equities. So if you look at valuations, compared to global equities, so the 80% of the portfolio invested in UK equities, the market as a whole is trading on a PE of about 11 times. So that's a sort of 35% discount to global equities. And even if you adjust for sector differences, that's still around a 20% discount. So in absolute terms, the UK market is cheap, and also relative to history. I think only in the global financial crisis has it been sort of trading on a lower PE than it is now. The portfolio itself, given the focus on quality, it's slightly more expensive. So it's on a PE of 13 times. But I think that is a very small premium to pay for better quality companies in terms of a higher return on equity, better margins, better earnings stability as well. So UK markets, it's attractively valued. And I probably should add as well that not only is the UK equity market attractive value, but with Murray Income is also trading on around about a 7 or an 8% discount. So you do at the moment have this double discount in terms of valuations. I think sometimes people forget the attractiveness of many companies in the UK in terms of their exposure to global growth, companies with really strong competitive advantages, world-class standards of corporate governance. And I think what you've seen, over the last 20 years is sort of pension funds sell down. So they've gone from 50% exposure to UK equities to about 4%. It's difficult to see that going much lower. And then since really 2016, international investors as well have also sort of sold down. So, or at least they've been significantly underweight. And again, that underweight position is at a very high level compared to where it has been historically. So it may well be the case that that can't go much lower. And given the attractive valuations, I think there's sort of really very significant potential for M&A. And many of the companies in the portfolio, I think, good quality companies are vulnerable. And typically, if you look at what private equity is interested in a company, that sort of really dovetails with many of the features that Murray Income is also looking for in its holdings. And then sort of why equity income? So dividends, a key long-term driver of total returns. Clearly, there's an important functional purpose as well. Post-COVID, many companies have rebased their dividend. Payout ratios are now more modest. So that provides a good base for dividend growth. And if you look at the yield on the market and the yield on the Murray Income portfolio, which is about 4%, and compare that to other regional equity markets or global equities, which are yielding about 2.5%, then clearly that is attractive. And given the discount at the moment as well, so the yield on the shares is 4.5%. So the final page really is just a summary of what we're trying to do with the portfolio. So the 3Ds again, we want to be dependable, the focus on high quality companies, resilient income, good capital growth prospects, benefiting from the strong team, the proprietary research, the corporate access, maintaining this patient long-term buy and hold approach, being diversified in terms of sector and income and capital, investing in some of the best overseas listed companies, having a healthy exposure to attractive mid-cap companies and having that little bit of option writing. And then the differentiation in terms of the focus on high quality companies, diversification, those overseas listed companies, mid-caps, a little bit of option writing, and again, the strong ESG focus with the AA rating by MSCI, which is one of the best in the peer group, and the no tobacco holdings in the portfolio. And the outcome of all of that, the attractive yield, the potential for strong capital growth, but also resilience in challenging markets. And over time, that has delivered attractive returns with low volatility. So that is Murray Income.
Great, thank you very much, Charles. Also stop tour around Murray Income. Let's sort of focus on the sort of structural stuff first. Do you use gearing in the fund? And if you do, how do you determine what the appropriate level should be?
Yep. So we have, we think about gearing sort of on a strategic basis. So as a means over the long term to gently amplify returns. So I don't think I have any sort of particular skills in predicting market moves in the short term. So not tactically trying to time the market. Gearing is about 9% at the moment. So the absolute level of debt hasn't actually changed since the merger with Perpetual Income and Growth. And just to talk a little bit more about that how that gearing is made up. So we have £100 million of longer-term loans. So two loan notes, one 40 million, which is due in 2027, paying a 2.5% coupon at the moment, and another £60 million of loan notes, which are due in 2029, and they're paying 4.4%. And we've also got a bank revolver as well, of which about 6 million is drawn down. But the blended interest rate at the moment is about just over 3.5%. So sort of sensible, modest level of gearing to gently amplify returns over the long term, and we don't try and sort of tactically change things to try and predict market moves.
Great, thank you. And then you talked about the discount. So have you been buying back shares? At what point would you think the board would buy back shares?
Yeah, so the discount is monitored very closely by the board. The actual policy isn't disclosed publicly, but we have been very active, particularly over the last 18 months, buying back shares. And over that time period, we bought back about 7% of the shares, and those are held in treasury because we like to reissue them one day. And you can sort of correlate the buybacks with the discount. So we've been buying back shares, over the last couple of months, very actively, really.
Okay, great, thank you. Can you explain a little bit more about how the option income works, please?
Yeah, so the option writing program, and so this is something we've been doing for 14 years or so now, so it's very much tried and tested, is based on fundamental analysis. So when we think a company is a little bit overvalued or it's a high weight, we can write a call option, and virtually all of the options are covered call options. And what we're effectively doing is, at a slightly higher share price, we're selling a very small part of the holding if the shares if the share price increases. And in return for giving someone the opportunity to buy that small holding, we get some income, which is the option premium, which we can distribute to shareholders. So, as I say, sort of very much based on fundamental analysis of the individual holdings. There's no systematic option overlay. It typically accounts for somewhere around about 5% of the total income. It's helpful because it does provide this additional uncorrelated income stream, and also a little bit of additional headroom to invest in some of those companies with strong long-term capital and dividend growth, which you perhaps typically wouldn't see in a normal income fund. And at any one time, perhaps 3% of the portfolio is overwritten. So and that will be on a range of different companies with different sort of durations. So there's a very, very limited market directional risk that's being taken as well. And as I said, it's worked very well for the last 14 years or so.
So, I mean, typically you're selling the upside in something, is that right? So
yeah.
Yeah.
So it's a very, so if you take Relex, for example, so there's a call option written on Relex for 0.25% of the holding. So given the strong performance of the shares, the likelihood they will be assigned, and the weight will go down from 5.8% to sort of 5.5%. But we would have gained a little bit of income in order to give someone the opportunity to buy the shares at a slightly higher price.
Yeah, great, thank you. Okay, obviously it's COP28 starting this week. Can you tell us a bit about, because obviously you're saying you don't hold any tobacco, but why oil, and how do you square that from the ESG point of view? Yeah,
so I think if you look at oil and gas and mining, so we have holdings in both those sectors in the portfolio. So on the one hand, clearly from an environmental perspective, and also one could argue from a quality perspective as well, arguably not the really top highest quality companies, and clearly there are environmental issues as well. But on the other side of the equation, you do have oil and gas and mining do provide diversification, and they do provide a dividend yield or income as well. So where we've focused our holdings, particularly in the oil and gas and the mining sector, is on those companies that we think are best placed in terms of the energy transition and their investment in renewables. So in oil and gas, we have holdings in BP and Total Energies, and in mining, we have holding in BHP and Anglo American, which are both, we think, focused on future-facing commodities. So we do have holdings, but we're very much aware of how they fit into, or how their environmental credentials fit into the energy transition. And then does Aberdeen as a whole engage with these companies as well? Yeah, absolutely. So we spend a vast amount of time engaging with all the companies in the portfolio on very many ESG topics and factors. And actually, in the last month, we talked to the BP chairman. On this occasion, it was about a new CEO, but on many occasions, it's about environmental issues and their strategy too.
Yeah, great, thank you. What's been driving performance recently?
Well, in terms of how we performed over the last year or so, I mean, a number of companies that have done well. So we benefited from the likes of Sage, Novo Nordisk, and Microsoft. They've been helpful. In terms of some of the companies that have been a little bit weaker, we had a holding in Croda. That was disappointing. That's actually now been sold. Questions over the quality of that investment, really, after a couple of profit warnings. The company was losing market share. Operating leverage was a little bit higher than expected. And valuation post the downgrades was still looking quite full. So that's actually now been sold from the portfolio. But that was an example of a company that hadn't helped performance over the last year or so.
Right. Okay. Thank you. I see financials as a decent weighting here, but there aren't any banks that I can see in the top 10. So what sort of attitude have you got towards the UK banks at the moment?
Yeah. So we have investments in small holding Standard Chartered, OCBC, and Nordea. So prefer the higher quality banks. So higher quality, I mean a higher return on equity, and sort of the better growth potential of those sort of companies that perhaps aren't exposed to the UK. So we don't own any high street UK banks, but we do own the three I mentioned, because we feel that that particularly the exposure to Asia and outside the UK, and the attractive valuations as well, make them better investment opportunities.
Okay, thank you. In terms of dividend growth, I'm guessing that's set by the board, but is it just done in relation to how the underlying revenue is growing, or is there some other sort of magic at work there?
Yeah, so clearly maintaining the track record of dividend growth is very important. So the starting point is really having a portfolio that's able to do that over the medium to long term. So I mean, the yield at the moment on the shares is 4.5%, and I have a rather large spreadsheet which has all the holdings and their dividend growth, what I think their dividend growth will deliver over the next 5 years, and being quite conservative. I can see over the medium term the portfolio delivering 5% dividend growth, and hopefully that will be above inflation over the medium term. So we should hopefully continue our track record, deliver real income growth as well, from a relatively high starting yield. But I think the sort of nuance of the market at the moment as well is that quite a lot of companies are buying back shares. So rather than distributing income as dividends, they're buying back their shares because they see valuations as attractive. So as I mentioned earlier, the yield on the portfolio is about 4%. But if you were to include buybacks as well, so the sort of distribution yield is actually sort of 5%. So I think, so to answer your question, I think actually the future in terms of dividend growth is good, because you saw some of the companies and the long-term tailwinds they're exposed to, and the good quality nature of the holdings. And hopefully we can continue to deliver sort of mid to high single digit dividend growth on average over the sort of medium to long term. And actually, if you go back 50 years and think about that starting yield in 1973 and where we are today, the portfolio has actually delivered, or the shares have delivered, a compound annual growth rate of just over 9%, which is that's pretty good going, really, I think.
Yeah, exactly. Think about it. In terms of the sort of UK market, then, can you see a catalyst for a re-rating? And I know you're sort of saying that we can't really get much worse. I think I probably kind of agree with you there. But is there something you think might trigger a re-rating?
I think, well, I mean, I think there are sort of a number of factors that potentially could. So, as I mentioned earlier, M&A in terms of companies buying other companies, or private equity becoming more involved in the market, but also those share buybacks continuing. So I think if we saw some macro reasons, so inflation closer to target levels, and interest rates perhaps beginning to fall, or maybe just a sort of a more stable political environment, or there's lots of talk about UK market reform. If there was something substantial to encourage investment into UK equities, that might be a factor. But I think maybe sometimes if you do have better market performance, that can create its own momentum. So potentially a period of strong performance could feed on itself as well. But I would say that, I mean, with Murray Income, you're pretty much paid to wait as it is, because you're getting a 4.5% yield, and as I mentioned, you should see dividend growth of mid single digits at least over the long term. So that gives you a good total return, whilst you sort of hope that we see some sort of capital appreciation as well.
Yeah, thank you very much. Okay, I think we're sort of running out of time a bit, but I've got one question that gets asked quite a lot. And do you invest in the fund yourself?
Yes, yeah, absolutely, yes. So I'm very significant investment for me in the fund, and my wife invests in the fund, and I have a 9-year-old son, and he doesn't know this, but he has a junior SIP, which is also wholly invested in Murray Income. So he will certainly be hoping for another 50 years of dividend growth.
Great, that's good. Well, thank you very much. We covered an awful lot of ground this morning, and thank you very much for going back over the Murray Income story again. And we shall wish you all the best, and maybe talk to you sometime next year.
Certainly. Thank you for your time, and thank you for everyone listening.
Great. Thanks for everybody listening today. We'll be back next week. I'll be talking to AVI Japan Opportunity, so Joe Bamford again. And then we're going to have a break. So we will be back on the 5th of January, and then Andrew and I are going to rehash what we did at the beginning of this year. We're going to talk about the whole year and the individual sectors, what went up, what went down, and why, hopefully. So that's all to look forward to. And then we've got a sort of full lineup of things. I know somebody asked me about trying to get Midwind on, and we have approached them. So I think that list is going to get full up beyond 9th of February quite quickly too. So thank you much for your time again. Have a great weekend. It's snowing outside as I look at this, so wrap up warm, and I'll see you next week.